You say earnings, the season we're into now and into next week's tech extravaganza, is the catalyst to break out of a range. So many disagree with that.
Yeah, well, earnings have been the key reason why this market has been so very resilient. If you're revising up earnings estimates, it does something really powerful because not only are you increasing your estimates for profits, but you're also providing the environment to be able to expand multiples. Multiples go up when you're revising estimates higher. They tend to go down when you're cutting estimates, which just means that as long as we're in a world where people still need to ratchet up their numbers, it means that you can be in this world where valuations can levitate at high levels.
Paul, Walmart, it's gone from 40 to 42. It's a multiple expansion.
Multiple expansion.
Walmart,
exactly.
A PE of 42.
So, Cameron, what do you make of this earnings season so far? It seems like the numbers, once again, just like the second quarter, coming in well above expectations.
Yeah, we've seen 86% of companies beat earnings expectations. That's pretty much in line with average. That's very normal. You have a lowered bar going into earnings season, and then you jump over that lowered bar. But we see very strong results across the board, and that's not something that surprises us. What is very interesting is some of the reactions to strong results, which just means that you're not necessarily seeing big upside moves, even though you're seeing beats and raises, which just suggests that maybe some of those multiples did get to a point where they can't push much higher.
Very good. I mean, I'm looking at the bond market here. We've got 10-year Treasury yields below 4% here. What is the bond market telling us here?
This is very peculiar because given all of the strong narratives that we have about U.S. economic growth, look at Atlanta Fed GDP now being at 3.9%. You have talk about all this AI capex and great earnings, and yet the 10-year is below 4%. So the big question we have is the 10-year sending us a signal that we should be more concerned about equity and credit, the 10-year pricing in maybe a more dire economic scenario, or is the 10-year falling because of things that could actually be beneficial to equity and credit, such as expectations for quantitative easing or expectations of inflation remaining contained? Big question.
This is really brilliant. This is the word I use, folks, ambiguity, where it can cut this way or that way. John Riding is brilliant about this over at Breen in terms of the economics. Explain the 10-year yield ambiguity or almost mystery and what it means for someone looking at the 401k saying, should I go further Cameron Dawson long?
Yeah. Well, I believe it is a Bloomberg tagline that says context changes everything.
Nice.
And
have her back, Aaron.
I think that the context of why the 10-year is falling is so very important. If you have a 10-year falling because you're pricing in a bad economic scenario, that implies lower earnings, lower valuations within risk assets, which implies a risk-off move. But if the 10-year is falling because you have a very aggressive Fed that's going to be buying up a lot of bonds on the long end, or you have this ability where the Treasury's not having to issue as much, then that can actually be an environment where lower yields is still good for risk assets.
Torsten Slack moments ago, it's like he wrote it for you. Thank you for listening to Cameron Dawson, Torsten over at Apollo. The U.S. is truly unique. 30% of the global stock market, almost 50% now, Paul.
Yep, and it's just amazing. And that kind of goes to where I want to go. Concentration risk. It's been something we've been talking about for more than a year now, it seems like. But it doesn't seem to be a problem for the market per se. But we've been all raised and all educated that we need to have a broadening breadth of the market.
Look, if we go back in history, the two past peaks of concentration were during the Nifty 50 time at the end of the 60s, as well as at the peak of the tech bubble in the late 90s. And what happened after both of those periods were effectively lost decades of returns for equities. And lost decades do happen. However, the challenge you have is it's the timing, because if you try to bet against concentration, being early is the equivalent of being wrong. So what we think we need to have is a catalyst as to why that concentration unwinds. And for us, that catalyst is earnings growth of the Mag 7.